Briefly on the legal side, the content of this video is for educational and informational purposes only. It does not constitute investment advice or a recommendation to buy. All analyses, models, and strategies represent personal opinions. No guarantee of accuracy or completeness is given. The full disclaimer can be found at the end of this video and in the video description.
Hello, and welcome to our first individual stock analysis of L4F Finance. If you haven't seen our introductory video on the L4F 3 steps process yet, be sure to catch up. I've linked it here for you. There, you'll learn how we work and why we do some things differently from other financial channels. Today, we're getting straight to the point, and yes, it's going to be exciting.
Today, we delve deeply into individual stock analysis, and with a real heavyweight, Novo Nordisk. And with that, we are taking the title straight through our L4F 3 steps process. Why Novo Nordisk in particular? There are three reasons for this. First, a stock decline of around 60% within just 12 months. Second, a hyped mega-cap stock that everyone is talking about. Third, it has already been analyzed countless times by other finance YouTubers. It means we are dealing here with a madness crash, a hyped stock, and plenty of existing analyses. Perfect, therefore, to demonstrate whether we can truly add value. And a great opportunity to show you how important risk management is. Because in the end, it's about your money, and you want to preserve and grow it in the long term. Before we dive deep into the 3 steps process, let's first address point 2 as a special section, because it is entirely about risk management. Take a look at this chart from Novo Nordisk, showing an overview of the past 5 years. The major decline started on 1st July 2024, right from the top. Perhaps some of you joined just a few months earlier. Back then, it was everywhere. Buy the dip, meaning buy again when the price falls because it's supposedly a good opportunity. The banks are rushing to make future predictions. This mega-cap stock, mega-cap by the way, means companies with huge market capitalization, was considered a must-have. Every setback was supposedly a buying opportunity.
And if we had become critical at that point, many probably would have thought, what kind of fun killers are these? New channel? No idea. Typical.
This is not criticism. This is pure psychology. After each correction, it went back up, and that is exactly what shapes your thinking. Remember our introductory video. Buying a great company at the wrong price can cost you dearly. Imagine the top at 130 euros, then on September 1st, 2024, down to 100 euros. And analysts call it a great buying opportunity. Those who bought earlier at 110 euros might think, buy more or hold. Losses can quickly be recovered. Today the price is at 43.80 euros. That means before you reach your entry point again, an increase of around 150% would be needed. Whether you can withstand this mentally and financially is the question. And what if the fundamental data worsens and it only rises to 80 euros before the price falls again? Then the difference is huge. The newcomer makes a 100% profit, while the experienced investor remains deeply in the red, staring at a red figure in the portfolio. This is risk management in its purest form. It was extremely important to me to say this before our analysis, perhaps as a prompt for you. Because at L4F Finance, we don't want to lecture you or celebrate ourselves when a forecast turns out to be accurate. It's about keeping an eye on opportunities and risks, especially with individual stocks, which are inherently riskier than broadly diversified ETFs. It's not about super timing with the super financial influencer, but about capital preservation rather than gambling. You don't have to agree with me. Feel free to write it in the comments. But that's what L4F Finance stands for. A community that wants to improve because it learns from mistakes and exchanges ideas. And yes, that also applies to me as your trailblazer.
Well then, you're just our warm-up coach with a safety helmet, as long as no one trips over during the handstand in the depot.
Exactly. Better a cautious investor with capital preservation than a polar bear swimmer in the negative pool.
Axel, a quick question beforehand. This will be almost a 30-minute video. That's pretty hardcore. Can it be shorter?
Everyone has to answer that for themselves. But here's a bit from me. The risk management note was a special section. It alone takes about 7 minutes. Future videos will probably last around 20 to 23 minutes. And honestly, if you want to do all the work yourself, read everything, understand it, do the calculations, you'll spend 4 to 6 hours on it. Is 23 minutes of compressed, high-quality analysis really too much when it comes to an investment you might hold for 5 years?
Okay, Axel, the bar is set high. Today on the test bench, Novo Nordisk, an absolute superstar on the stock exchange, which has plummeted over 60% after a profit warning and a CEO change. From darling to show me story. So, let's guide this fallen angel through your process. Let's start with step 1.
Imagine we have a company under scrutiny that is currently dominating the global headlines, celebrated for its successes, but also highly risky. That's where we start. Our first step is based on 3 solid pillars that give us a complete 360-degree view. And the first pillar is so in-depth that it could provide enough material for an entire program.
3 pillars just for the first step? That sounds like you're really leaving nothing to chance.
Exactly. Pillar 1 is our forensic financial statement analysis. We literally interrogate the company and dissect the financial reports from 2020 to 2024. The whole process takes place in 5 phases. And right in the first phase, it gets really exciting.
5 phases? Now you have to pick me up. What's behind it?
We start with the overview analysis of the 2024 annual report. And here we go through each point in detail. Test stat, 5 out of 5 points. Came on February 5th, quick, clean, without restrictions. This indicates excellent processes. Confirmation note, also 5 out of 5. Everything disclosed, even the critical US discounts. Executive communication, 5 out of 5. Confident, honest about bottlenecks and price pressure, clear focus on GLP-1 products. Sales development, 5 out of 5, plus 24% growth driven by the obesity care segment with plus 144%. But the USA contributes plus 31%, a massive concentration risk.
Result quality, 4 out of 5. EBIT, plus 22%, high margins, but deduction due to special effect and dependence on blockbusters. Balance sheet and equity, 5 out of 5. Equity ratio over 40%, fully financed from ongoing operations. Liquidity and cash flow, 5 out of 5. Operating cash flow exceeds profit, increasing investments, no significant debts. Payout policy, 4 out of 5. Dividends and buybacks are growing, but the main shareholder is a foundation. Limited flexibility. Reporting, 5 out of 5. First CSRD report with high segment transparency. Overall score, 48 out of 50 points, 96%. That sounds like an exemplary company. But you mentioned there are strategic weaknesses?
Yes, and we find them in phase 2, the time series analysis from 2020 to 2024. Revenue growth jumps from plus 7% 2020 to plus 36% 2023 and plus 24% 2024, driven by Ozempic and Wegovy. EBIT grows from 54 billion Danish kroner 2020 to over 102 billion Danish kroner 2023. Margin remains consistently above 40%. Goodwill stays low. Growth is almost entirely organic, but CapEx has exploded since 2022.
And any corpses in the cellar? That would then be phase 3, the hunt for irregularities.
All checked. Development costs high, but activated in accordance with IFRS. Provisions for US price issues are openly disclosed. No hidden risks with deferred taxes or pensions. The risk report is exemplary, clearly identifies dependencies, competition, regulation. Phase 4, the cash flow analysis, confirms from 2021 to 2023, the operating cash flow was always higher than the profit.
And in the end comes the royal discipline, the SWOT analysis in phase 5.
Exactly. Strengths, GLP-1 leadership, stable balance sheet, high margins, strong pipeline, top management. Weaknesses, dependence on GLP-1 in USA, production bottlenecks, high US prices. Opportunities, global obesity market, new technologies, pipeline. Risks, Eli Lilly competition, generics, patent expirations, regulatory issues.
Okay, Pillar 1 is complete. A fundamentally healthy company from within, but with clear strategic risks. What does Pillar 2, the Analyst Check, say? Does the market still believe in the story?
Well, Lisa, this is the exciting turn. From an outside perspective, Novo Nordisk still appears at first glance to be a superstar, a global pharmaceutical giant from Denmark, leading in diabetes and obesity treatments with blockbusters like Ozempic, Wegovy, and Rybelsus. They serve over 43 million patients worldwide, and in recent years, their growth has literally exploded.
That still sounds like a picture book. What's the catch?
The catch is the stage has changed. Financially, they are doing well. Gross margin around 85%, revenue increase of 24% last year, but they are under massive pressure. Competition, Eli Lilly with Mounjaro and Zepbound is approaching dangerously close. Management change, new CEO M. Dustar from August 2025, and this follows a profit warning. Forecast reduction. The revenue forecast for 2025 has been cut from 13 to 21% down to just 8 to 14%. Share price development. The stock has plummeted over 60% from its high. Confidence is shaken.
Ouch! And what do the analysts say?
As of 3rd August 2025, share price $48.20. High was $138.10. Analyst target price, average, $73.55. Significantly higher than the current price. PE ratio, 13.1. Currently, 11.9 forward. Historically low. PEG, 0.73. Attractive growth potential. EV/EBITDA, 9.32. Dividend yield, 3.67%. Historically high due to the low share price. And the profit forecasts, 2024, plus 12.9%, 2025, plus 13.0%, 2026, plus 10.4%. But for Q2, 2025, the EPS estimates were reduced by 10%.
Also fundamental figures top, but the sentiment in the seller?
Exactly. Downgrades from BMO Capital Markets, Market Perform, Target 64, and Bank of America, neutral, speak volumes. Cantor Fitzgerald remains overweight, but with an old target of 160. Actually, as always, now the target prices and outlook are simply being passed downwards. Let's see how long Fitzgerald will stick to the target of 160, roughly 140 euros. Welcome to Wonderworld. Momentum-wise, minus 63.8% in a year. All indicators say strong sell.
What do the strengths and weaknesses look like from an analyst perspective?
SWOT analysts. Strengths. GLP-1 portfolio, strong figures. Weaknesses. Dependence, competition, supply chain, and reputation risks. Opportunities. Obesity boom, new indications. Risks. Eli Lilly, regulation, product failures. To complement our own view, strengths, duopoly with Eli Lilly, market power, high margins, strong brand. Weaknesses, concentration risk, loss of trust, CEO change, opportunities, pipeline, global expansion. Risks, existential competition, price pressure, execution risk.
Sounds like a test of strength on a knife's edge.
Exactly. Wall Street is divided into two camps. Bull case, huge opportunity in the obesity market, potential Medicare reimbursement in the USA, strong pipeline, Amy Cretin, stock clearly undervalued after the crash. Bear case, Eli Lilly as a game changer, price pressure in the USA, CEO change and downward revision of forecasts as a confidence shock.
And the latest news?
In the last 60 days, there have been three major shocks. 29 July 2025, forecast downgrade plus CEO change, massive share price plunge. 1st August, Medicare news, possible reimbursement for weight loss drugs in the USA. August, further analyst downgrades, growing skepticism.
What does that mean for investors?
The core message, Novo Nordisk remains the market leader in an extremely attractive segment, but the proof is yet to come that they can overcome this crisis. Turnaround scenario, management must get production, pipeline, and pricing under control. Risk-reward. Valuation historically low, but there is a risk of a value trap if margins or market shares continue to decline. Strategy. Interesting for value and growth investors with patience and risk awareness. Currently unsuitable for momentum investors.
Also conclusion, analysts see a PE ratio bargain, but they don't quite trust it yet.
Exactly. The numbers shout cheap. The confidence whispers, wait and see.
Okay, Pillar 1, operationally healthy. Pillar 2, analysts suspicious. What can we expect now in Pillar 3, the quantitative check?
Here it's especially exciting, Lisa, because now we're laying the hard numbers on the table and comparing Novo Nordisk with itself, with the competition, and with the market. And believe me, the picture is ambivalent.
Well then, go ahead.
Let's start with the trends from 2020 to the first half of 2025. Revenue and margins steadily increased until Q2 2025, when headwinds suddenly became noticeably stronger. Price competition, capacity limits, all at once. The investments are enormous. Expanding production and new active substances like amycretin are costing billions. Competitive pressure? Eli Lilly is gaining strength, generics are threatening, and policymakers are increasingly involved in price setting.
A real higher, faster, further, until the first stumbling blocks appeared.
Exactly. Now to the figures, as of the first half of 2025, revenue from around 127 billion Danish kroner 2020 to 290 billion 2024, and already 155 billion in the first half of 2025. EBIT margin 42.5% in 2020, now 46.6%, a record value. Free cash flow 70 billion 2023 to an estimated 80 billion 2024. Distributions 65 billion in 2024, dividends plus buybacks. Balance sheet, equity ratio over 60%, almost no debt.
Still sounds like a picture book. Where's the hitch?
Not in the valuation. PE ratio is 14.3, forward 12.36, attractive. PG at 1.44, dividend yield about 3.67%. ROE, an incredible 81.2%. But PS ratio 4.35, PB ratio 10.13, EV, EBITDA around 10.9. All high values, but not unusual for the pharmaceutical sector. And in comparison with peers, yes, the GLP-1 market remains a duopoly with Eli Lilly, but price pressure and generics are no longer future prospects.
Also brilliant figures, but a market environment that puts everything to the test.
Correct? And when you go through the table from 2020 up to and including the first half of 2025, you see everything is increasing. Revenue, EBIT, margin, cash flow, distributions, and yet the stock price mainly reflects fear of the future.
That brings us to the conclusion of step 1, doesn't it?
Yes. Novo Nordisk is a prime example of a fallen growth star now at a turning point. The operational figures are still impressive, but the challenges are real. Pillar 1, forensically impeccable, A+. Pillar 2, analyst skeptical, turnaround character. Pillar 3, valuation attractive in PE ratio, but momentum and sentiment clearly negative.
A company that stands fundamentally at the top and at the same time is treated like a problem case?
Exactly. That's what makes the stock so exciting. Operationally, a dream note. Analysts are skeptical. The market is torn. Those who think risk consciously and long-term might see a rare opportunity here. But the next quarters will decide everything. And that's exactly why, Lisa, things get really interesting in the next step. We're going to see how this finding influences our entire investment strategy.
And we will clarify that now in step 2, the L4F price GPS.
Exactly. This is our double evaluation and price zone analysis. Imagine we could see in black and white what the market has already priced into the rate today and how large the potential upward movement or risk really is.
Also something like a navigation device for the stock price?
Exactly. And at the current level of $48.76, 7th of August 2025, this is particularly interesting. Remember, the stock has plummeted by a hefty 60% from its high after profit warning, CEO change, and forecast reduction. Now let's look at what this means for investors in 2 scenarios. Variant 1. Base scenario. Analyst consensus. We assume that EPS will grow by 12% per year until 2029, from $3.30 in 2024 to $5.82 in 2029. Highest PE ratio, 22. Lowest PE ratio, 12. Optimistic price target, 2029, 128.04. Risk-averse price target, 2029, $69.84.
And where would the exchange zones be then?
According to our L4F logic, purchase zone 69.84 to 84.39, hold zone 84.40 to 113.47, sale zone 113.48 to 128.04. The catch: the current rate of 48.76 is well below the buying zone. This means a return potential of around 20.6% PA. In the optimistic case, even risk-averse investors could still expect 7.4% PA.
That sounds almost too good to be true. What's the catch?
We will clarify that in the next scenario. Now comes our worst-case scenario. Here, we assume only 8% EPS growth per year, from $3.30 in 2024 to $4.85 in 2029. Highest PE ratio, 18, lowest, 8. Optimistic target price, 2029, 87.30, risk-averse target price, 2029, 38.80.
And the exchange rate zones?
Buy zone, 38.80 to 51.93. Hold zone, 51.94 to 75.18. Sell zone, 75.19 to 87.30. Currently, the price is exactly at the lower edge of the buy zone. Optimistically, there would still be 12.5% PA, but risk-averse investors would face a 4.5% PA loss.
Even in the worst case, no classic value trap, but also no automatic success.
Exactly. That shows. Even if the market slows down, a lot of pessimism is already priced in. Why both variants are important? We want maximum transparency. You can see exactly how the valuation varies depending on the model. Even conservative investors recognize that the risk is largely embedded in the current price. And the L4F advantage. This double zone valuation logic precisely shows how much safety margin or pessimism is involved, something that traditional analysts do not provide. Final conclusion, step 2. Novo Nordisk is fundamentally strong, and the crash has already pushed many risks into the price. In both models, the current price is at least at the lower end or even well below the buying zone, a picture we haven't seen in years.
That means whether you're betting on a comeback or further weakness, the facts are now crystal clear on the table.
Exactly. And the next step will show how we can derive a concrete investment strategy from these data. Now comes the masterclass. The final step that puts everything into the right context. Step 3, the L4F Superinvestor Check. And here we do not ask, what do we think? But, what would the greatest and most successful investors of all time do?
Do you personally invite the legends to the table? That sounds like an illustrious group.
Exactly. We saw in step 1, strong fundamentals. In step 2, historically undervalued. But the market is nervous. Now we want to know how Warren Buffett, Peter Lynch, Benjamin Graham, and Cummers would view this situation. The 15 super investors in detail. Let's quickly highlight some key points. Buffett, quality at a fair price. Attractive after the crash, 71%, buy. Graham, margin of safety after the crash, 66%, buy, hold. Lynch, GARP bargains after correction, 85%, buy. O'Neill, fundamental growth stock, potential intact, 79%, buy. Minervini and Davos, momentum dead, trend broken, 22 to 23%, avoid. Kliman, market panic, buying opportunity, 81%, buy. Munger, world-class business, timing right, 74%, buy. Soros, extreme sentiment, speculative rebound possible, 60%, hold, trade.
That almost sounds like a battle between long-term investors and momentum traders.
Exactly. That is why we classify them by style groups: value, quality, Buffett, Graham, Munger, Klarman, Greenblatt, Dodd, Neff, 73%, majority say buy, hold. Growth, Lynch, Fisher, O'Neill, T. Rowe. Price Jr., average 77.5%, clear, buy. Momentum, Minervini, Davos, 22.5%, definite, avoid. Contrarian, macro. Marx, Soros, 65%, counter-cyclically, buy, hold, trade.
Also, value and growth are almost in agreement. Momentum is declining and the contrarians are lurking for excesses.
That is exactly what is exciting. Value, quality, and growth. Over 70% of the criteria met. From Buffett to O'Neill, rarely such clear buy signals. Momentum. Under 25%. Stay away until a reversal is confirmed. Contrarian, macro, almost 2/3 met. Perfect for contrarians when the market continues to overdo it. Our USP. We show you all positions, all opinions, all scores, and you can see for yourself which mindset suits your style. No traditional YouTube format makes this as transparent.
Does that mean the world's biggest investors would now at least partially invest, despite all the risks?
Exactly. And that now leads us to an exciting point, because when we combine all three steps, it creates a picture that should catch the attention of both conservative investors and daring speculators.
That is the clarity you need. Now everyone truly understands why opinions are so divided. It is crystal clear which camp favors the stock and where the professionals are still waiting. Also, Axel, we have now completed 3 steps, checked the foundation, analyzed the assessment, and consulted the legends. What is your overall picture?
When we put the puzzle together, it looks like this. Step 1, foundation. Operationally and balance sheet flawless. A+, with clear but manageable strategic risks. Analysts are skeptical, satisfactory, seeing a turnaround potential, quantitatively favorably valued, but momentum and sentiment are at rock bottom. Step 2, price GPS. In both valuation scenarios, the current price is at the lower end or well below the buying zone. In the optimistic base scenario, potential of over 20% PA, still significantly positive even for risk-averse investors. Even in the worst case, much pessimism is already priced in. Step 3, superinvestors, value and quality, 73%. Majority say buy hold. Growth, 77.5%, clear buy. And this is remarkable because growth usually buys more expensively than value. Contrarian, macro, 65%, also a buy-hold tendency. Momentum, 22.5%, clear break, but overcompensated at a long-term horizon.
It means 3 major investor groups largely agree, and only the momentum traders are waving them off?
Exactly. And when value investors, growth hunters, and contrarians all give a go at the same time while the price is in the buying zone, then that's a combination you see very rarely. Now you've seen how to go through a fundamental analysis process step by step to increase the likelihood of being correct and to significantly reduce the error rate. Our goal is to give you the tools so that you can make decisions yourself. For you, foundation, strong rating, historically attractive superinvestor majority, buy recommendation, negative momentum, long-term secondary. This gives me a clear verdict. For long-term oriented investors, classic long-term buy. I will buy the stock for myself in my portfolio. Only as a small addition because my focus is on ETFs. Individual stocks have a lower weight with me, 0.5% to 1%. But then we are back to my starting point of risk management. And if you've stuck with it this far, then you definitely have the perseverance for long-term investing. Or you just like our voices. But seriously, you now not only have an assessment of Novo Nordisk, but also a complete toolkit to make better decisions yourself.
Exactly, and that is the true gain, knowledge that endures.
Also, stay curious, think long-term, and see you in the next episode. Thank you for your interest.
Hello and see you soon.
Disclaimer: the content on the YouTube channel, Learn4Finance, is for educational and informational purposes only. All analyses, quantitative models, strategies, data preparations and content presented reflect solely personal opinions and interpretations. There is expressly no individual investment advice or recommendation to buy, sell or hold financial instruments within the meaning of Section 32 of the German Banking Act, KWG, or Section 85 of the German Securities Trading Act, WPHG. The information provided does not replace professional financial, tax or legal advice. The channel operator assumes no liability for the accuracy, completeness, or timeliness of the content. Viewers make investment decisions independently and at their own risk. Past performance, simulations or forecasts are no guarantee of future results. Important note, investments in financial instruments involve significant risks, including the total loss of capital. Please consider seeking independent advice from qualified professionals before making any investment decision.